I just want to thank everybody for joining us for this really exciting session about how to use your self-directed IRA to own real estate overseas, specifically in Belize. We have Jason DeBono here from NuView IRA. Jason and I have known each other, maybe 7, 8 years at this point, maybe
It's been a
even longer.
while.
It's been a long time, and Jason really is an expert when it comes to how to set up your self-directed IRA and then also using it overseas. And this has been a really popular model for people who are looking at ownership of rental real estate in another country. I know that's very popular for people who want to deploy their IRA savings and funds into something that's a little non-traditional. And so with that, I'm gonna quiet myself here and let Jason take over. Jason, you're up.
All right, Rachel. Well, thank you. And since we're talking about where we are geographically, I am in Florida. In some ways, wish I was in Belize, but Florida is not too bad this time of year. So for those in warm weather states, welcome. Those in cold weather states, certainly welcome as well. And I think international real estate and some of the warmer weather climates start to really look a lot more attractive this time of year. As Rachel said, we've worked together in a variety of capacities over the years, really just sharing educational content around how individual investors can really utilize retirement funds to invest outside of both the public markets, but also outside of the United States. So I'm going to talk today about how a retirement plan can do that. What are some of the things to be considerate of? And I'll start the first slide here with kind of the disclaimer, which helps everybody understand what we don't do. And I think it may make a little more sense in what we do. We are not real estate experts. We are not advisors. We're not attorneys. We're not CPAs. We're not here to endorse or approve investments. NuView Trust Company and NuView IRA, we're a third-party custodial firm that houses retirement money for individual investors. We custody over $2 billion worth of investments, all of which is invested into a variety of assets, predominantly real estate. And certainly we see a lot of international real estate inside that pool of real estate that we custody. So just keep in mind, anything you hear from me today is not to be construed as investment or legal advice. If you want to understand the underpinnings of real estate and the differences of why real estate and why international versus domestic, certainly I can talk at a high level, but folks like Rachel are the ones that can kind of help and guide you through that piece of it. And that's why we do so much joint education and educational events with other individuals, because we don't cross that line from into that investment standpoint. So happy to take any questions throughout the presentation today. I think Rachel pointed, for those that were on right when we started, to the Q&A panel. That's the easiest place for us to see them and read them out loud. I will take a look at them. If I don't read your question, it's because I'm either going to get to it or it's because we'll kind of hold it till the end and maybe take it as more of a general question. But keep those coming in. We really do appreciate that and want to make sure we cover what it is that you did join today's webinar specifically to hear. So there's a lot of buzz and a lot of terminology that we hear or people use called self-directed IRAs. And really, a self-directed IRA is a marketing term. The IRS didn't create a self-directed IRA. They created IRAs, traditional Roth Simple SEP, 401ks as an extension, which are employer plans. None of those, by virtue of the account, are self-directed, nor did the IRS ever declare in any of their documents the difference between a self-directed account and a non-self-directed account. What self-direction is it's really the marketing and buzz term that's used in our industry to help people understand that a self-directed account gives them the ability to direct the investments themselves without limitation at the custodial level. And so what I mean by that is you could have a retirement account that sits at Charles Schwab. However, you could self-direct it into any stock, bond, or mutual fund, but Charles Schwab is not going to let you own a piece of real estate in your IRA. And it's not because Charles Schwab can't, it's because they just don't want to be in the custody of manual type assets like real estate. So companies like NuView Trust exist not to compete with Charles Schwab, but to actually, work alongside them and hold the assets that individuals want to hold outside the market inside their retirement portfolio. So as we talk today, just remember, self-directing your retirement account is really the act of finding a custodian like a NuView Trust that will allow you to hold assets that are outside the publicly traded stock market or equities markets. So we'll talk about Some rules, some requirements, and we'll talk a little bit about some of the mechanics and underpinnings of how these transactions work inside of their accounts. So why is it, or what are the benefits of self-direction? We really like to point to three things. Number one, it's diversification. I think anyone that's been in the equities market in the last 5 years, right, we've seen certainly all boats rise. And then we've seen some turbulence over the last maybe 12 to 18 months, depending on, what area you may have been invested in. And what we find with a lot of investors is that while the market allows for diversification inside of it, right, different asset classes, different businesses, ultimately you're tied back to the public equities market. And I think we'd all agree, as it rises and falls, diversity gets harder and harder to pinpoint inside those equity markets. So not saying it's a bad place to invest, but we believe that true diversification includes both public equities as well as private equities, as well as individual real estate and a variety of things. So self-direction gives you that greatest ability to truly diversify. The second thing is investing in what you know best. I don't know the background of the participants on today's webinar, but I'd be willing to bet the vast majority of you know more about real estate and its basic premise than you do about how stocks and bonds work. You have a probably better feel when real estate's going up and down versus when stocks may go up or go down. And then lastly, with investing in what we live in real estate, we understand it, we pay rent or pay mortgages on real estate, we may own investment real estate. That's very common. So that knowledge can be translated into your retirement account for additional real estate-based investments. And then lastly, the tax savings. What most people are unaware of is that if you buy real estate within a retirement account, in this case, a self-directed IRA, all of the tax benefits that your IRA has are also going to be covered on that real estate investment. And that's something that's incredibly exciting, because one of the big benefits of retirement accounts is that you're either deferring your tax liability or you're eliminating your tax liability in the case of the Roth. And in either case, regardless of the investments, real estate, public equities, or the like, you maintain those same tax deferred or tax-free growth strategies that your IRA affords you. So it's a way to not just buy real estate for diversification, but it's also to buy real estate and buy it really in a truly tax-free manner, which there is no way to do that with your personal money. Not in the way that you can do it with retirement money. So for those three reasons, the knowledge and understanding of real estate, the true diversification, and then you couple that with the tax savings, those are the things that drive people into utilizing self-directed retirement accounts to actually go out and purchase real estate. So we're going to touch on kind of the restrictions, because we hate to say there's rules, but ultimately there are some rules that we need to make sure that we follow. And the rules are pretty straightforward and simple, but you've got to understand them. Now, these same rules apply at Schwab and Fidelity, because these are IRS rules. These are not NuView rules. These are not Schwab or Fidelity rules. The reason that most people don't know of the IRA rules is because when you buy stocks and bonds, your ability to violate one of these rules is very, very difficult, if not impossible. And that is because you're buying specifically public equities. But when you get into buying real estate and other private investments through a self-directed account, you can buy from, whomever in theory and buy whatever you want. And so the IRS says, hey, let's make sure that we put a little bit of protection around the activities inside these accounts so that there is no easy ability for people to commit tax fraud or violate really the intent of your IRA. So I'll start by saying IRAs were created to allow you as an individual to save in a tax-advantaged manner for your retirement. And if you kind of keep that thought process in mind, it's for you when you retire, these rules will make a little bit more sense. So the rule number one has to do with people. The IRS says your IRA can go out and make investments into really anything that you want, right? There's very few restrictions. However, they want to make sure that the parties involved in those transactions are considered arm's length. The people that they don't want your IRA doing business with are considered prohibited transactions or disqualified parties. Those parties are yourself, you as the IRA owner, your spouse, your parents and grandparents, children and grandchildren. By extension, any of those parties' businesses or any of those parties' spouses are also prohibited. So I'll give you an example. My IRA could buy a piece of real estate in, let's say, Belize today. There's nothing preventing me from doing that. Real estate is permissible. Real estate international is permissible, and Belize is a permissible place for me to own real property inside my retirement account. No restriction at all. However, if I bought that piece of real estate from my father, the IRS would prohibit it. Not because it's real estate, not because it's in Belize, but because they don't want my IRA, which is tax advantage, making a transaction directly with my father. So if my dad owns a piece of real estate in Belize today, what would keep him from selling it to me at a severe discount, taking a tax loss on his personal tax return, and my IRA getting this undervalued or under purchased property at a very low cost, putting all those tax profits into my account tax free. So the IRS says, because of those opportunities, they prohibit those parties. So just to recap, you, your spouse, your parents and grandparents, children and grandchildren, and the spouses and businesses of any of those parties. So when you think about making an investment, it's not the real estate that would ever be prohibited. It's real estate that involves a close family member that would make that transaction prohibited. And it's no different than if your father was the CEO of Microsoft, your IRA would likely be prohibited from buying shares of Microsoft, right? We don't run into that issue, at least most of us don't, but the rules apply over the public equities market. It's just not nearly as common. And again, it's all around protecting the tax integrity of the account. I'll pause there and remind everyone, I know this is a lot to cover, and I'll cover it quickly. But if you do have questions, please type those into the Q&A, and I'll happily pause and get those answered. So now would be a good time if you have any to put those in there. The second area of restrictions is pretty straightforward. No life insurance, no collectibles. So when you look at a transaction, right, we're talking about real estate today, that's not on the list. So real estate is a permissible investment, just no life insurance, no collectibles. So with a self-directed account, unless life insurance and collectibles are your investment strategy, the only real rules that you have to navigate are making sure that your transactions are done at an arm's length. Arm's length means that the relationship of the parties does not in any way dictate the terms of the deal. So if you buy at market rates, sell at market rate, rent at market rates, and do not do business with disqualified parties, those parties I just mentioned, you can literally buy and sell whatever you want as it relates to your self-directed account. So hopefully at a high level, you at least get a handle on that. Some of the things that we also want to make sure that you're aware of is that direct and indirect activities still count the same in the eyes of the IRS. So you can't buy, sell, trade, loan, or extend services. One of the things that comes up, and I'll just get out in front of it today, and it comes up frequently, is if my IRA wants to buy a house in Belize, can I do that? And the answer is yes, so long as you're buying it from unrelated parties at fair market rates, whatever those are defined as. If the answer to that is yes, I'm going to buy a piece of real estate from somebody I don't know at market rates, can my IRA do that? The answer is yes. Once you own that property, it is owned in the name of your IRA, and we'll talk about that from a mechanic standpoint. But when it comes time to rent, utilize, lease, or sell that property, you still have to act with unrelated parties. And so just make sure that you're thinking about these disqualified parties for the life of the transaction. And also understand that personal use is prohibited by the IRA owner and that same group of disqualified parties. So if your IRA does buy a piece of real estate in Belize, if your intention is to go live there or go use the property, then the IRA may not be the right tool for you. This is specifically for passive investments without any active benefit to you, the IRA owner, or any disqualified parties. So something that we always like to get out in front of. It does come up. Unfortunately, you cannot use your IRAs, but at the same time, all of the profits that come into that IRA are completely tax-free. So you're trading off personal use for tax-free growth, which for most people is a very, very good trade. I've got it looks like, So I think the question, it was a question, and then it looks like I may have gotten to it, but I'll just reiterate the question. Thank you, Felicia, for putting it in. The question was, do restrictions go both ways? Example, can you sell to a family or gift? What happens if you die? And so, yeah, I think I covered that in terms of any activity on the buy side or the sell side or anything in between would be prohibited. One question that was asked was, when you pass away in an IRA, your IRA has designated death beneficiaries. So if I pass away and let's just say I leave my IRA to my wife, the IRA moves just like it looks today over to my wife. And from there, my wife has to now follow the same sets of rules and guides that I had to follow with that real estate. So it would be her property. She could sell it back to her IRA at any point, or sell it and take the proceeds back to the IRA, but she would also have to follow the rules of who she sold it to. No different if you leave it to kids or grandkids or any other party. Once it's passed through death, the assets still remain assets of the IRA. And then all of the prohibited transaction rules that we just discussed would now apply to that IRA owner, which in a lot of cases, depending on who you leave your account to, it's the same group. But if you left it to, say, a friend, people that may not have been prohibited while you owned it may become prohibited during your friend's ownership. So something to be mindful of there. And we'll talk a little bit about, the idea of a retirement strategy, maybe not to own property and retire and live in it while you own it, but maybe to own it for, let's say, 10, 20 years down the road, and then have it for retirement. So we'll get to that here in just a minute. So when we talk about, what can you do, this is a general slide just to give some insight into what IRAs can do. And real estate, when we say real estate, we don't differentiate between international or domestic. In our eyes, real estate is real estate. We'll talk on the next slide about some international real estate considerations specifically. But real estate of all types, single family, multifamily, options, condos, unimproved land, commercial property, and then special purpose. We've seen clients invest into teak farms, boat slips, coffee plantations. If you name it, if there's a way to get deeded ownership to it in the form of real estate, we probably have had clients do it along the way. So all types of real estate can be held, and we'll talk about how to even set those up and structure those. Deborah has asked, are you saying in order to buy real estate with my IRA, it must be for an investment, but not to live in the property only? The way it's written, the answer is yes, it's for investment purposes only. So if your IRA buys a piece of real estate, it cannot be for any form of personal use, whether it be for the night, the week, or permanent. It has to be for investment purposes only. Doesn't mean it has to be a rental. It could be raw land, or it could be a condo that's never rented. It's just bought for appreciation. Those are investment decisions. But yes, all real estate bought within an IRA must be exclusively for investment purposes only. So no personal use of you or any of your family members that we've put on the list. So just some considerations as it relates to international real estate. These are just a couple of things that you want to take a look at. And I'm sure Rachel can touch on any of these specific to Belize or any of the other areas that she represents. But number one is taking title. When you own real estate in an IRA, the titled owner is the custodian for the benefit of your retirement account. That means that NuView provides custody. We don't own the property, your IRA does, but we are the designated custodian for that particular asset. In international real estate, you'll want to understand if you need to buy it through an entity or if you'll be buying it direct. And we don't have a preference or a requirement, but different countries may have different requirements for different types of real estate. So just something to be mindful of. The second thing is managing your property. Certainly, if it's international and you don't reside in the same area, it's an important consideration to make sure that you're, identifying someone that can be, on the ground, whether that's a management company, whether that's a property manager. And we see a variety of these things. Again, I think Rachel could probably give some better guidance, but we like to just make sure people kind of give thought to that. The third item is your capital investment or capital amount. And we're going to talk about whether you buy a property via cash or whether you take on a non-recourse loan, and we'll touch on that to make a purchase. And then fourth, in-country requirements. Every country has their own laws and requirements to purchase real estate. You need to make sure that you're working through someone like Rachel or a professional that can help you understand what those requirements are and how to satisfy those, whether it's reporting, whether it's upfront activity. Just make sure that you're aware of those. And then lastly, personal use restrictions. As attracted as we all are to certainly be in Belize or any other country with warm weather right now, we need to make sure that if you're using your IRA, that you're foregoing the desire of any personal use while your IRA owns it, or you'll need to look at purchasing it outside of your IRA if personal use is one of the things that you're most interested in. So I'll walk you through just a quick kind of case study. This is pretty straightforward. You can change this out however you'd like. I like to talk about single family real estate. Generally is the easiest to describe, although this would work no different in any sort of condo or multifamily type investment. So in this case, it's a $300,000 investment. It's a 3-2 with a pool. Key components off to the right there. The first one is how you title it. You are not the buyer, your IRA is, and you want all the tax benefits. So you want to make sure your IRA is designated on title. And you do that by titling it NuView Trust for the benefit of, in my case, Jason DeBono's IRA. And whether you buy it direct, meaning your name is on the deed as written, or whether you buy it through some sort of entity in the country that you're purchasing in, either one of those works. Just understand what that looks like so you can guide and direct us in how to purchase that. We see a lot of these that utilize Airbnb, VRBO, local management companies. How you choose to find your renters, assuming it's a rental. This is just for illustration, but that $1,000 to $2,000 a week, whether it's high or low season, is the rental fee. All of those rental proceeds go right into the IRA, completely tax free. In this case, there's a local property manager that's there to help and assist with the property taxes, insurance, management, cleaning fees, utilities, whatever the expenses are that are associated with that property, all get paid out of the IRA. So right on our website, we have a bill payment system, just like you would see it like a Bank of America. And you can direct all of those payments to either automatically be paid, or you can go in and enter them as those payments become due, either one. But just know that all expenses and all income flow in and out of the IRA as the owner of that property. So when you think about it, it becomes almost a self-contained investment. And it's really important that everything flow through the account from a tax standpoint. And the beauty in transactions like this is that, hopefully both the investment income is for profit, and then there's proceeds when you sell that property. In both cases, there's no tax liability due on the rental income, nor is there a tax liability on the proceeds of sale, which is great and something that is really nice for investors, because they've now made an investment into something they believe will generate great returns, but they've also done it in that tax advantage manner, which is really the secret sauce of the IRA, and something that's really exciting for investors when they start making profit and not having to pay Uncle Sam a piece of those profits. So when you buy an investment in an IRA, there's really 3 ways that you can structure that deal. The first way is all cash. So in this example, it's a $300,000 piece of property. If my IRA was going to buy it, my IRA would have at least $300,000 in it. I would be a cash buyer. All income would go into my IRA. All expenses would go out of my IRA. The second way would be to have multiple buyers buy the same property. So in this case, if it's a $300,000 property, maybe it's my IRA and my wife's IRA buy the property 50-50. As long as we're not transacting through each other, but alongside each other, that's permissible. So if you think about it, my IRA could buy shares of Microsoft, just like my wife's IRA could buy shares of Microsoft. So when you buy with multiple parties, right, partnering, for lack of a better term, everybody has to be a cash buyer for their portion. And you can split this up however you'd like. So my IRA could buy a third, Rachel's IRA could buy a third, and a friend of mine could use their personal money and buy a third. We would each have a declared pro rata ownership based on how much money we brought to the table, and all the income and expenses that arise from that property would be split in that same manner. So if we bought it a third with my IRA, a third with Rachel's IRA, and a third with a cash buyer, then when rent comes in, we would put a third into my IRA, a third into Rachel's IRA, and a third would go to that individual's, traditional cash account. When there's expenses, we would pay those out a third, and a third. So you can split it up however the money in dictates. Just know that everybody gets a pro rata interest based on how much money they bring to the table. And that pro rata interest has got to be carried through income and expenses, so long as the ownership structure is set up that way. The third way is to actually go out and get a loan. In order to get a loan in an IRA, it must be a non-recourse loan. You'll have to look at international lending requirements in the country in which you may be borrowing, but non-recourse loans are I would say they're not overly common, but they're not uncommon at all. Typical down payments on non-recourse loans are going to be about 30 to 50%. And the reason for that is there's no guarantee on the repayment of the loan. They're just securing the property or the loan by the property itself. So if you think about a traditional mortgage, the bank gets two things. The bank gets the property as collateral, and then they get your individual personal guarantee that you'll repay the loan. In an IRA loan, the only thing that the bank gets is the actual property itself as collateral. There's no guarantee from you as the IRA owner, as that's prohibited, which is why you have that higher down payment requirement. The mortgage is paid by the IRA. So if my IRA takes on a non-recourse loan for this $300,000 house and there's a $1,500 mortgage payment, that payment is due by my IRA. So I would collect the $1,000 to $2,000 a month as it's rent, or a week as it's rented, and then I would use those proceeds to pay my $2,000 mortgage payment every single month. Again, all expenses and all income all flows in and out of the retirement account. And then lastly, while your IRA is a tax-free or tax advantage vehicle, in the event that you do borrow money in the form of a non-recourse loan to buy a property, there's a tax called unrelated debt financed income that may trigger. It's only a tax on your profits that were against the borrowed money. So if you borrow 50%, you're taxed only on 50% of profits. If you borrow 80%, you're potentially taxed on 80% of your profits. So there's a lot of strategies around non-recourse loans and eliminating or avoiding UDFI completely. But for the sake of today, that's a lot more content and complexity to go through. So we'll kind of table that, but our team is happy to answer those questions as you want to walk through there. The last thing I want to touch on, and then we'll open up the floor for Q&A and then turn it over to Rachel, is a strategy that we see individuals deploy really to buy real estate with the future intent of using the property. So I'll use Belize as an example. So I am not yet ready to retire, although I'm working very hard to get closer to that. But I may see prices of real estate in Belize today and think to myself, man, 20 years from now, right, or 30 years from now, when I actually retire, I don't know that I'll actually be able to afford that property. So, and if I believe that and I want to lock down property today because I think it's a great investment, but not utilize it till later, then there's ways for me to do that. The most common way we see that done is in a Roth IRA. And the reason for the Roth IRA is to get the tax bill out of the way. And if I bought that same property today for $300,000, my Roth IRA owns it. I had to pay tax to get the money into the Roth. So there's some cost for me to deploy the strategy. But all of the income and expenses flow through my Roth IRA, and let's just say for the next 20 years. And that property is now worth 600 or 800 or $1 million, dollars, however you care to calculate out the forecast. When I'm ready to retire and utilize that property, let's just say, when I turn 60, I can withdraw that property out of my Roth IRA 100% tax-free, regardless of what it's worth. And now it's my property and I can go live in there tomorrow. So what you've done is you've acquired property at today's prices. You've benefited, hopefully gravely, from the returns annually, right? From the rental proceeds less the expenses. So it's hopefully been a good annualized investment for you, building up cash in your retirement account. And when you retire and you're ready to live there, you've withdrawn the property out of the account and you've paid no tax to do so. So if it's appreciated to $1 million, you've just ultimately taken $1 million worth of value out of your IRA completely tax-free on an investment that you made, 10, 20, 30 years ago for $300,000. So there's some additional strategies there that we can certainly take some time and chat about more on an individual basis. But I always like to at least wrap up with that, because I know a lot of people are trying to maybe kill two birds with one stone, or trying to make good investments, but utilize money that's available today, but also thinking about retirement or thinking about maybe what the next 10 or 20 years looks like. So, with the exception of some general personal use, there's a lot of different strategies that can be deployed to satisfy whatever goals and objectives that you have from an investment standpoint. So I will open it up to questions through the Q&A. And then I can, let's see if I can get Rachel on, and in case people have questions that may be directed at her. Rachel, can you hear us okay, or hear me okay?
Yes, perfect. And actually, I know I have a few questions that I was writing down over here too for you, Jason. So if people get a little stuck on what to ask, don't you worry, because I have some things that I can jump in and ask too. So I'm glad that you talked about how people can use their property that they've used through their self-directed IRA eventually into retirement, because I know that that's a big question that we get asked a lot. Now, the other one I wanted to know is, you mentioned that you can have partners in the investment, right? It just depends on how much capital somebody's bringing to the table, and then the profits and expenses are split evenly between those people, or however prorated based on how much they've invested. Now, can you be an investor with yourself? Right. So let's say you have your self-directed IRA, be 50% owner, and then you say, you know what, I actually don't have enough money in my self-directed IRA to be a full owner of this property, but I have enough personal funds. Let's say it's a $300,000 property. Your IRA puts $150,000 in, you put $150,000 in of your personal money, and then you're able to use it a little bit. I know it can't be self-serving, but I get that question a lot. So just wanted to get it clarified.
Yeah, I mean, the short answer is yes, you can do it. Your IRA has the ability to invest alongside anyone else, even disqualified parties. And that's can be a very confusing consideration, because I just spent the beginning saying you can't do business with yourself. Yet here I am saying, sure, Rachel, your IRA can buy this property and you personally can buy the other half of the property. At a high level, there's some pros and cons to it. And it, like any strategy, it will work for some, but not others, right? And that's the beauty of strategies, is it's just finding the one to deploy that makes the most sense for you and your financial situation. So when you partner with yourself, the drawback is the whole property is treated as if your IRA owns it. So personal use doesn't become available to you. And the reason for that is, when you own real estate with a partner, you don't own the kitchen and the bathroom, right? And the laundry room, and the other partner owns the bedrooms. It's, you own 50% of the whole. And the IRS basically declares anything that your IRA owns any percentage of to be disqualified from personal use. So that piece of it, unfortunately, is a little bit of a trade-off, but I'll talk about some things I've seen to I hate to say even get around it, but some strategies. The second piece of from a pro-con standpoint that we see a lot of people love is that it allows them to, especially if they're looking to buy something for retirement, it allows them to make a little bit of personal investment, a little bit of IRA investment, and build wealth, whether that's for retirement or whether that's building wealth personally, all at the same time. Now, some of the things that I've seen on the personal use side that potentially can be split is we've seen if you buy a property that's part of a management pool, or you buy a property like a condo, that you may be entitled to 2 weeks at the property. And we have seen documents drawn up whereby the weeks are split to each party. So Jason's IRA gets 1 week of personal use, which is of no value, and Jason gets 1 week of personal use. I just can't use my condo, right? Because that is the one. But if I can use the amenities or the resort or whatever may be accompanied with that. So there are some ways to possibly get a little bit of the personal benefit. But as far as using your individual investment specifically, whether you own it 1% or 100% in the IRA, that personal use piece, unfortunately, is off the table.
Well, good. And I'm glad we clarified that, because I know, folks, it's so tempting, especially when you're buying real estate and owning real estate in a really beautiful tropical country, to be able to want to use it, right, and go down and occupy it and whatnot. But you just have to understand that when it is in your self-directed IRA, and it's an investment, right? And that's just how you have to treat it as well. And just note that eventually down the line, you can be able to come to it and occupy it later on in life once you get to that retirement stage, but just not quite yet. The other question I wanted to ask you was about financing. So in Belize, and you may know this or you may not know this, but in Belize, there's not the traditional bank financing, right? Especially for foreigners who are coming in and buying real estate. There may be one bank in Belize that will finance for foreigners specifically who are owning property in the country, but it's not really traditional. So what we see is a lot of property sellers are actually the ones who offer the financing. Now, I know you said it had to be non-recourse, which makes sense with what's going on down here in terms of financing. But does that still work for the IRA if it's seller financing? There's not like specific bank documents or anything. It's usually like a note, right? A promissory note or a note, but it's nothing more intense than that.
Yeah, it absolutely works. The IRS's rules, believe it or not, are actually, they're very simple. What they want to make sure is that I, Jason, an individual, am not doing anything that would violate the tax integrity of my IRA, because there's some significant tax benefits that IRAs offer.
Right.
The personal guarantee, the reason that the IRS prohibits a personal guarantee is they don't want me pledging my personal income and my personal credit and all of those other things to earn money tax-free, because that's what they're worried about. Otherwise, everybody would do that, right? I would pledge every asset I had to lever up my Roth IRA as big and as fat as I could. And if things go south, it hits me personally as opposed to hitting my IRA. Right. So seller financing, bank financing, it really doesn't matter. The only thing that is required is that the loan documents, and when we say loan documents, there's no formal loan document. It can be written on a cocktail napkin, or it could be a 4,000 page Bank of America loan document. But somewhere in there, it just needs to notate that the collateral for the property or for the loan is solely the property. And that there's no personal guarantee made by the IRA owner. Got it.
Okay, got it. Yep, and that's definitely doable here. I see Felicia was asking about the historical rate of return on a property over the last 5 and 10 years. Ooh, Felicia, that is such a loaded question there. It really just depends entirely on the property. Obviously, with COVID, numbers dropped, to virtually zero for a lot of investors. But I can talk to you more specifically about that offline. I know that when you're looking at property, especially from the investment perspective, you do want to know that there's cash flow. Now, we do have to know that there's nothing guaranteed when it comes to an investment, right? I can't say, all right, I'm going to guarantee you 8% return, because it really just depends on the market. And if somebody's ever guaranteeing you a return on investment, I would be very, very careful and probably run away, not even walk away at that point, run away, because there's nothing that's guaranteed in life. Well, that one thing that you're going to die. But other than that, you really can't guarantee that. But I can talk to you about that, Felicia, which actually brings me to another question here, Jason, is, let's say you have a limited amount in your IRA and let's say something like COVID hits, right? We had no idea that it was coming. People weren't prepared for it. And perhaps they didn't have enough in their IRA to cover fees for a property that wasn't renting. What happens in that case?
Yeah, and I think you have to kind of look at investing in real estate a little differently than a stock, because anytime you have an investment that relies on the income to pay the expenses, you always run the risk of the income underperforming or the expenses going up. And there's a variety of factors that cause that. COVID, I think, was one that really across the board put everybody in the same predicament, which is, if I didn't rent my property for 8 months, I still had 8 months worth of payments. How do I manage that? So a couple of things. I mean, first, we always recommend, just like any real estate investment, IRA or not, that you always have a cushion of cash. If in my example, I used of $300,000, if my IRA had $300,000, I probably shouldn't buy a $300,000 property. But we also understand at times, sometimes you take a little more risk than you'd like if the right deal comes along, and maybe what you thought would be a $20,000 cash reserve became $8,000 for the right deal. So we get it. The second piece of that is you can always make your annual contributions to your IRA to personally add money into the account to cover expenses. So the amount you're eligible to contribute does vary by account type. So there's no one size number, but most IRAs you can contribute at least $6,000 to. So you have that ability should something go bad, but that's also limited to your personal ability to add money and your eligibility on that. The third way is to actually over contribute to your IRA. It's not something that you should do, but we understand in a scenario like COVID, maybe 8 months of expenses is 10 grand and your contribution limit is 6. You can over contribute and pay a 6% penalty until it's washed out. Meaning, if I put in 4,000 extra this year, next year, if I leave the $4,000 in there and don't add any more, it's washed out under the following year's eligibility. So I've got a 6% penalty for 1 year. That's something that, we consider it's the safety net of safety nets. Again, it's your ability to contribute to the account, but it also, it's like getting a bank loan. People say, well, there's a penalty. And I'd say, well, if you made the investment personally and didn't have the money to pay the expenses and you had to go get a loan, it's going to cost you more than a 6% penalty in terms of interest or fees. So it's something that you really want to be as conservative as your investment strategy desires. We have clients that have no money in their account and they own property and they scramble every month to make their payments, and that's their prerogative. And I've got, the vast majority of our clients have ample cash in their account, or they have stocks or bonds or other investments that are easily liquidable in the event that they need it, or transferred in from Schwab. So, most of our clients are not putting 100% of their retirement account into a single property. They may own 3 or 4. And so if property A is struggling, property B, C, and D are helping to resolve it. So, it's good strategy overall to make sure that you're considering what could go wrong, because I think we all learned through COVID and that things can be humming along as nicely as you'd like, and out of the blue, anything can cause some temporary or more permanent challenges associated with our investments.
Yes. And good. Thank you for that. I'm glad that you laid out the 3 different ways that somebody can find a way to make it work. I see another question here from Felicia. This is probably more for you, definitely more for you, Jason, than for me. So I'll let you answer it.
Yeah, and I'll read it out as written. And Felicia, I may get a little qualification or additional content just to make sure I answer it correctly. But it says, if I were to invest in a property with my kids, each of us placing in our IRA, when I pass, can they put my share into their Roths? So at a high level, it really doesn't matter what an IRA owns. The death beneficiary rules are the same, whether it owns stocks or real estate. So we'll just take the investment piece off the table for a minute. There's been some changes over the years to inherited IRAs and death beneficiaries across the board. Again, not tied in any way to the investment strategy, but to an IRA. Historically, there were a few different ways that individuals could take retirement accounts. So if, let's say, I passed and I left my account to my kids, they could take the IRA over their life expectancy, or they could take it over a 5-year period. They had a few different options. Today, those options have been pared all the way down to 10 years. So when somebody passes away, I have 10 years to withdraw the funds out of the IRA I've inherited. The only exception to that is spousal IRAs. So if I pass away and leave my IRA to my spouse can make that IRA hers. So she could take the IRA and just simply move it into her account. It becomes her IRA. She's eligible to withdraw it when she's eligible to withdraw it. She's under no time constraint. If I leave that same IRA to my children or anyone else, they cannot make it their own. They have to withdraw it over a 10-year period. And the reason that they've done this, whether you agree with it or not, is because they are waiting on the tax revenue in most cases on these accounts. And when they allow the beneficiaries to take it over their life expectancy, the amount of time they're forced to wait on the tax revenue just gets extended beyond their desire. So it's not the end of the world. It's just something you got to strategize, but it certainly is a big difference between leaving it to a spouse and leaving it to a children.
Awesome. And I don't have any more questions over here. I don't see anyone having questions either. If you, Jason, would be able to make me the host for a moment,
Yep.
I just want to show folks a couple of options available for usage. Awesome. And be a minute there.
Give
And
me
then
1 second here.
of course.
Make sure.
And folks, I do, and I'm going to reiterate this again. I know, Jason, you've said it a few times, but please make sure that when you're using your IRA to own real estate, it really is for rental, awesome. It is for rental purposes. I've had some clients previously who tried to get a little creative with it, and we're trying to find other people in the development or in Belize that owned through their self-directed IRA as well, which I think is the great loophole there, because you're not personally using yours either, right? If you do want to occupy it, but I would just not go in with the intention of you using it until you're later to able to transfer it over. But I did just want to mention a couple of opportunities that I think would be great for rental real estate. Again, I can't guarantee any rentals income. I can tell you that you're going to be getting a 10% from this because it really just depends on the market. But this has been a popular one for folks. This is all on Ambergris Key I'm mentioning. And when you are looking at your real estate and you are trying to figure out numbers, and especially from investment, you want to go where the people are going. You want to go where the renters are going. It doesn't really matter if you personally like the location that you're investing. This is investment minded, right? You have to see where people are going. So this one is a great option. It is for luxury canal front condos or villas located on Ambergris Key. These start at about a little under 200,000, and there is 50% financing available. So I'm glad, Jason, that you mentioned that you are able to do the seller financing or developer financing. It does still qualify you for ownership here. And folks, these are just some simple options. I'm going to give you 3. If you see anything that you're interested in, feel free to reach out to me. There's always more in the marketplace too, though. So these are just some options. Here's another one that has not quite listed yet. It is coming out later this week, but it is for a luxury high-end condo. It is facing the Caribbean. You look right out. You see the sunset or sunrise rather. You see the reef breaking there on the water. It's a very, very stunning property. This one's a 2-bed, 2-bath, and it is a little bit more than the traditional investment property. It is about 600,000. There is 50% financing, but this one rents very, very well. And so the owners actually have 3 properties here in this development, and they're all doing well financially for them, cash flowing. So I did want to throw this in there from an investment perspective. High quality, just absolute luxury. And then the third, this one is at the Marriott Autograph, which is here on Ambergris Key as well. And again, when you're thinking about investment property, right, you want to think about what's going to rent well. And this is at a branded property. So they have the benefit of it being in the reservation system for Marriott. So they have that ability to find the renters, right? It's the largest reservation system in the world. So thinking about the rental numbers. And again, this one's a little bit higher, but there is financing available there for up to 60%. So this one's going for about $659. and then you have that financing available. So again, just some options. There are certainly more, but I just wanted to throw that at you. Also, we do have two webinars coming up. One is a property update for Aruna. That's that canal front one I showed you. That's this Friday, the 16th at 2 p.m. Eastern. And then also later on this month, we're going to do a quick overview about what you need to know about HOA homeowners associations in Belize. It is a little bit different than it is in the States or Canada. So I do want to highlight that with you. And last but not least, I told you it's going to be a quick update. Feel free to reach out to us. I added Jason's email address here, IRAspecialists@NuViewTrust.com, IRAspecialists@NuViewTrust.com. And I do want to mention too, I know a lot of folks listen to these sessions on YouTube afterwards. So from my property perspective, some of the information may have changed if you are looking at that after it's sold or later on. But if you want the latest and greatest information from Jason's perspective, feel free to reach out to them there. And like I mentioned earlier on, I've known Jason for about 8 years. You know, he's the president now of NuView. He's extremely knowledgeable. As you can see, we were just throwing questions at him left and right. And he knows what he's talking about. His group knows what they're talking about as well. And I'm guessing some of you have specific questions that you want to know that's a little bit more personal for your situation. And so feel free to reach out to them. They can always do a consultation with you. Do note that obviously in order to use your self-directed IRA, through them, you do need to set up an account, and you will need to transfer over your IRA to NuView. I know some of the bigger firms, the Charles Schwab that we mentioned before, they may be just dragging their feet as you tell them you want to close your account with them and open it up with a different company that gives you more flexibility and options, but they are obligated to do that for you. So reach out to Jason and his group there. You're in great hands with them. And Jason, anything before we turn off the session here?
No, not at all. I think we covered a tremendous amount. And just to reiterate, I think you nailed it. This is not meant to get too deep into any one individual strategy or into any of the personal, things that are important to each of you individually on the call. So, certainly take advantage of myself and our team if you have a strategy that you're considering, or, you may be looking at something and you're just not sure how it works. We understand. We do this every day and have for many, many years. A 30 to 45-minute crash course is certainly not going to give you everything you need to make an informed decision. So we're here to help any way that we can as it relates to the IRA side of the equation. So certainly use us any way that we can provide assistance.
Fantastic. Well, with that, I'll let you all go. I know it's a Tuesday morning here as we're doing this session, but I want to thank everybody for joining. I also want to thank all of those who made it to the end of the session while watching it up on YouTube, and feel free to reach out to us. Jason, I really want to thank you and your team at NuView for making sure that we were able to get this done and together, and the great information shared with everybody. And folks, go set up your accounts at NuView and own property with us in Belize. Thank you, everyone.
Thanks, Rachel. Thanks, everybody.
Bye.